Imagine a scenario where the planet's largest proven oil reserves are suddenly severed from the global supply chain in a matter of hours, triggering a shockwave that rattles every trading desk from New York to Tokyo. This is not a work of geopolitical fiction, but rather a harsh market reality we are dissecting today regarding the dramatic event we are calling the U.S. Venezuela raid. When diplomatic tensions escalate into asset seizures and physical blockades, the impact does not stop at political headlines. It strikes directly at investor portfolios through a brutal spike in commodity volatility. Is this the catalyst for a new commodity supercycle, or merely a moment of transient panic? In this video, we will deeply analyze how this Venezuela raid is rewriting the playbook for oil, gold, and silver, and exactly what strategies you need to deploy to insulate your portfolio against this lethal geopolitical risk. To fully comprehend why the Venezuela raid or U.S. intervention against Venezuelan assets is so pivotal for financial markets, we must step back and examine what is actually at stake in a nation often overlooked by retail investors, yet constantly monitored by smart money. Venezuela is not merely a Latin American country enduring a prolonged economic crisis, but rather the custodian of the world's largest energy vault with proven oil reserves exceeding those of Saudi Arabia, totaling over 300 billion barrels, largely concentrated in the Orinoco Belt. The history of U.S.-Venezuela relations has been defined by extreme oscillations, ranging from the strategic partnerships of the pre-Chavez era, where U.S. Gulf Coast refineries were specifically engineered to process Venezuelan heavy crude, to the crippling tiered economic sanctions that have paralyzed PDVSA's export capabilities in recent decades. This tension has reached a new boiling point as the narrative of a raid, essentially the strategic seizure of assets, begins to dominate the news cycle, representing an escalation of economic warfare where the U.S. moves to secure assets or block regime funding through cargo seizures, aircraft confiscation, or the freezing of central bank gold. This context is critical because markets despise uncertainty, and Venezuela is the very definition of uncertainty given its unique position of possessing immense natural wealth, including vast gold reserves in the Arco Minero del Orinoco, while lacking the infrastructure or political stability to monetize it efficiently without foreign interaction. For investors, understanding this background is the first step in realizing that every headline regarding a Venezuela raid is not just political noise, but a tangible signal of supply disruption for global commodities. When we speak of a raid in a market context, we are speaking of the erasure of access, and in a commodities world where the supply-demand balance is incredibly tight. The loss of access to reserves the size of Venezuela's, or even the perception of that loss, is sufficient to trigger a fear premium across asset classes. We observe a historical pattern where every time sanctions are tightened or physical assets like state aircraft or tankers are seized, the market reacts as if the supply tap is being forcibly closed, and this is the fundamental foundation one must grasp before we delve into the more technical price analysis. Having established the historical context and the natural resources at stake, let us dissect the mechanics of this Venezuela raid event and how it transmits shockwaves into the global financial system through psychological and logistical channels. When news of a seizure operation or raid by U.S. authorities against Venezuelan assets breaks, the market's initial reaction is not a long-term fundamental calculation, but a fight-or-flight response, reflected in an instant volatility spike. Within minutes of the news hitting the wires, high-frequency trading, HFT, algorithms, scanning for keywords like sanctions, seizure, or raid, immediately trigger sell orders on risk assets and buy orders on safe havens. This is a classic risk-off phenomenon, where capital flows aggressively out of equity markets, sensitive to global growth, and into hedging instruments. The psychological impact of this Venezuela raid is highly specific because it touches two main nerves of the global economy simultaneously: energy security and currency stability. Institutional investors immediately project worst-case scenarios where this U.S. action could trigger an asymmetric retaliation, not just from Venezuela, but from its strategic allies like Russia or China, potentially expanding a regional conflict into broader global geopolitical tension. We need to look at volatility charts like the VIX or OVX for oil, which typically surge sharply in the first 24 to 48 hours post-event, signaling that market participants are panic buying portfolio insurance. Furthermore, the narrative of this raid often raises speculation regarding legality and international precedent, where investors begin to question the safety of other emerging market assets held in U.S. dollar denominations or Western jurisdictions, which in turn creates selling pressure on emerging market currencies. Sentiment analysis indicates that raids of this nature are often perceived as black swan catalysts, or at least gray rhinos, risks that are known to exist but are ignored until they charge at the market. In this phase, fundamental logic regarding how many barrels of oil are actually lost is often temporarily sidelined in favor of liquidity risk management, where investment managers prefer to liquidate speculative positions rather than get trapped in potential further asset freezes. Thus, the second phase of the Venezuela raid impact is purely about sentiment fear and the repricing of geopolitical risk, where the market attempts to set a new price for a world that suddenly feels far less secure and more fragmented than the day before. Transitioning into the tangible physical impact, specifically the shock to the global oil market, the Venezuela raid carries consequences far more complex than a simple price hike at the gas pump. To understand the oil market impact, we cannot simply look at Brent or WTI prices in general terms. We must dissect the quality of the oil itself because Venezuela is a primary producer of heavy, sour crude. Refineries along the U.S. Gulf Coast have historically been configured with billions of dollars in investments to process this specific heavy Venezuelan oil, and when a raid or sanctions sever that supply flow, these refineries face a serious input crisis, as they cannot easily substitute it with light, sweet crude from American shale fields. This creates a unique market dislocation. While WTI prices might rise due to general sentiment, the physical price for heavy crude grades can skyrocket proportionally higher, squeezing refining margins and ultimately driving up prices for derivative products like diesel and asphalt. Historical data shows that whenever Venezuelan supply is disrupted, we see the spread or differential between various oil grades narrow or widen drastically, creating arbitrage opportunities for physical commodity traders, but a nightmare for industrial consumers. Furthermore, the Venezuela raid sends a signal to the market that OPEC Plus might need to act to balance the market. Yet the world's spare capacity is currently running thin, making every supply disruption feel significantly more painful. We must also account for the illicit trade routes, or the shadow fleet, that Venezuela has utilized to skirt sanctions by shipping oil to Asia. A more aggressive raid by the U.S. implies a stricter crackdown on this ghost fleet, effectively wiping millions of barrels of oil off the black market that had been quietly helping to stabilize global prices. If this supply suddenly vanishes due to tanker seizures or port blockades, we are talking about a structural deficit in the oil market that could push crude prices through key technical resistance levels, such as $90 or even $100 per barrel, depending on the macroeconomic conditions at the time. Therefore, the oil market impact here is twofold. There is the headline price spike due to war fear, and there's a real logistical crisis at the refining level due to the loss of a specific hard-to-replace oil grade, all of which contributes to energy inflation that will be felt across the entire global economic sector. While the oil market convulses due to physical disruptions, the precious metals market, specifically gold and silver, reacts to the monetary implications and systemic fears triggered by the Venezuela raid. Gold, as the oldest and most trusted safe haven asset, typically becomes the primary beneficiary of any escalation in tension involving the United States. As institutional investors and central banks seek protection from potential fiat currency devaluation and bond market instability, in the context of Venezuela, the gold narrative becomes even more compelling, because Venezuela itself sits atop massive gold reserves that are often the center of international dispute, such as the case of their gold held in London. When the U.S. conducts a raid or aggressive intervention, this reinforces the investment thesis that owning physical gold with no counterparty risk is the only true insurance. We often see gold prices breach important psychological levels immediately following major geopolitical news, because investors move capital from paper assets to real assets. Equally important is silver, which often moves with a higher beta or greater volatility compared to gold. In a conflict scenario, silver plays a dual role not only as a monetary metal, but also as a strategic industrial commodity. If the Venezuela conflict widens and disrupts global supply chains further, fears regarding inflation will drive demand for silver as a more affordable inflation hedge for retail investors. Historical charts indicate that the gold-silver ratio often experiences high volatility during geopolitical crises, providing significant trading opportunities for those who understand these dynamics. Furthermore, the Venezuela raid highlights the geopolitical risk of holding sovereign assets, which encourages central banks in Eastern nations to accelerate de-dollarization and accumulate more gold as neutral foreign exchange, reserves a secular trend that serves as a fundamental driver for a long-term gold bull market. Thus, the impact on precious metals is not merely a knee-jerk reaction, but a validation of the long-term thesis that, in a world becoming increasingly polarized and sanction-heavy, gold and silver are the only assets that cannot be easily frozen or digitally seized by foreign powers. The rise in gold and silver prices post-raid is a reflection of eroding trust in the traditional debt-based financial system, and savvy investors use this moment to accumulate defensive positions. Having dissected the historical, psychological, and fundamental impacts on the oil and precious metals markets, This final section serves as a practical roadmap for you as an investor to navigate the turbulence caused by this Venezuela raid. The primary conclusion is that volatility is a double-edged sword. It can destroy an unprepared portfolio, but it also provides incredible entry opportunities for those with a clear strategy. The first point to note is never to chase the candle the moment news breaks. As a technical correction often occurs after the initial panic subsides, allow the market time to find a new equilibrium before you enter. For oil exposure, consider diversified energy ETFs or shares of integrated oil majors that possess strong balance sheets, and the ability to capitalize on rising crude prices without direct operational risk in Venezuela. For gold and silver, a strategy of dollar cost averaging during corrective dips is a wiser approach than buying all at once at the peak, because the geopolitical risk premium can deflate as quickly as it appeared if a diplomatic solution is reached. Also pay close attention to macro indicators like the dollar index, DXY. Typically, the dollar strengthens during a crisis as a safe haven, which can be a headwind for commodity prices in the short term. But if this conflict erodes long-term confidence in the dollar, then commodities will reign supreme. Diversification is your key defense. Ensure your portfolio is not overly concentrated in assets sensitive to a single geopolitical outcome. As a closing insight, remember that this Venezuela raid is just one piece of a larger puzzle involving a shift in the world order toward multipolarity, where control over natural resources returns as the primary determinant of economic power. For long-term investors, this is a signal to maintain an allocation of hard assets like commodities and precious metals as a permanent part of the portfolio to protect purchasing power against inflation and inevitable future geopolitical risks. Stay vigilant, continue to monitor fundamental data, and do not let emotions dictate your investment decisions in the midst of this market storm. That concludes our deep dive analysis into the market impact of the Venezuela raid. If you found this information valuable and it helped you see the bigger picture behind the price action, please hit the like button, subscribe, and turn on the notification bell so you don't miss our next critical financial analysis. Let me know your thoughts in the comments below. Do you believe oil prices will break $100 as a result of this event? See you in the next video, and happy smart investing.